Hello, everybody, and welcome to CNF Talks. Today, I have the pleasure of interviewing Karl Mallon, who's the co-founder and Director of Science and Technology at XDI, which is the Cross-Dependency Initiative, part of the Climate Risk Group. Karl's going to be speaking at our Climate Adaptation and Resilience Summit being held in central London on the 1st of July. Welcome, Karl.
Thanks for having me along, Morris.
Very good to have you with us. Let's turn to our first question. You've described the physical risk journey as an arc similar to the journey we have been on with emission reporting. Can you explain how adaptation fits into this journey?
In a way, I think there's a lot to be learned for the journey we've been on the when we're looking at climate change emissions. So if we sort of cast our minds back, initially there was a sense of emissions. What are they? Do I even have emissions? So there's sort of point of ignorance of the idea that one should think about emissions. And then there was a step into saying, okay, well, all right, I can see that maybe I use electricity, or we have transport, or we're in a sector that causes emissions. And so there was a sort of acknowledgement that yes, all right, qualitatively. I can see that we might have a footprint. Then we went on to quantification. All right, let's create some methodologies to understand how big that emission footprint is. And then once we had that reporting, then you started to see folks saying, well, we're going to try and reduce our emissions. We're going to try certain emission reduction targets, and then finally we've arrived at a point where people are trying to get to net zero. So we're essentially going to get to a point where we're a neutral citizen, if you like, a neutral corporate citizen, and part of the solution. So if we apply that to physical risk, so physical risk says climate change is driving extreme weather events, and your first thing is, well, do I have any exposure to those? A lot of companies will kind of go, well, I'm in retail. Why would it affect me? I run offices or industrial estates. So this has got nothing to do with me. And then there's all right, okay, well, maybe, yes, we could have some flooding risk, I suppose, or extreme weather, does disrupt our business sometimes. So we're in that qualitative phase. And then now we're moving into quantification. Well, how big is the footprint? How many properties do you have in flood zones? How many properties do you have in a hurricane zone? Are you exposed to heat waves? Do you have to send your workers home if it gets too hot? Those sorts of things. So starting to get to quantities, and in due course, you can imagine investors and so on saying, well, what are you going to do about that? And so that's where adaptation comes in, and you might say that, well, people are saying, well, we're going to have a target, which is none of our properties are going to be high risk, or we're going to have a target that disruption from extreme event is going to be less than, say, a 1% impact on our business. Some targets, and in due course, I think we'll be seeing a world where supply chain companies that interact with each other are going to say, well, I only want to do business with you if you're going to show me that you are a low risk, high resilience business. So that the equivalent of a sort of net zero. So a similar process from ignorance, qualitative, quantitative, and then starting to address the problem and get to a point where they arrive at a position which they're comfortable with, and so are their counterparties and investors. So I think that's the journey we're on.
Yeah, and when you're talking to your clients, so it's not a question we necessarily planned for this interview, but when you're talking to your clients, what is the sort of range of increases in temperature that you look at when you're assessing their potential risks and liabilities?
So the emissions, the scenarios that we look at are essentially quite different from the scenarios in emissions and transition. So essentially there, if you look at a very, the sort of scenarios they might look at is policies that drive to very low emissions very quickly. Ours are sort of the other side, which is, well, what if emissions were uncontained and temperatures went up
Yeah.
considerably. Now, obviously, in an ideal situation, we keep them contained at 1.5 or 2 degrees.
Mm.
Unfortunately, with how much we've been emitting so far, we've been on trajectories that take us to 3 or 4 degrees, possibly more.
Mm.
Um, in general, we usually run what's called an RCP 8.5 or an SSP equivalent, and that is a high emission pathway. Now, fingers crossed, we don't tread that pathway.
Yeah.
Unfortunately, it's starting to look like some of those greenhouse gases in the atmosphere might start to be out of our control with tipping points. So feedbacks from the biosphere and so forth. And certainly, I think a lot, myself as well as other folks in the climate science community have been very alarmed at the signals from 2023 and even into this year, which are much higher than projected. So we may have to start to look at non-linear scenarios as well,
Yeah.
unfortunately. Yeah.
Turning to turning to financial institutions, there seems to be a big discrepancy between the scale of risks being reported by them versus the warnings of the climate science community. Why is that?
Um, it, it, in a way, it's like a jigsaw picture where there's lots of pieces, and we don't have all of the pieces yet. We've got some of the pieces.
Mm.
So we're starting to have pieces to say, well, if you've got physical assets, a factory, an office, a series of retail outlets, we can actually analyze those individually and understand the risks. Now, if I were looking at in the UK, I might say, well, 5% of those properties on average would be in a flood zone. Or I might say X% of those are going to be affected by heat going forward. And those will be very specific. But if I look at a factory and I say, what's the probability of it getting shut down by an extreme event, and I put a number against that, um, I have to acknowledge that, well, that factory needs power to be able to open the doors. It needs presumably a telecommunication link for the computers to work. It needs water. It needs road access so the staff can get there. So it's got 4 or 5 mechanisms for disruption beyond the factory itself. So if on a sheer sort of random balance of probabilities, there's 4 times more ways that factory can be shut down than a
Mm.
direct extreme event on the factory. So there's an example where we know that the if you like, the external factors that put that asset at risk are much bigger than the direct factors. So there's an example of where we've got some missing jigsaw pieces that we know are there, but we've got to put in.
Mm.
If I threw the net a little bit wider and I said, let's say we were looking at Miami, I might have
Yeah.
someone who said, well, I've got my factory and I've made it super secure and it's not vulnerable to flooding or sea level effects. And then they might say, well, now I've secured my power supply and my telecommunications, I've got all of that secure. Can that facility operate ignorant of the fact that Miami as a whole is exposed to sea level rise, which is that
Mm.
it's got quite a large economic exposure to things like coastal flooding. So again,
Mm. Mm.
we have to think about the context, and these are another set of jigsaw pieces that we need to put in to start to complete
Mm.
the puzzle. And and we can go further from there, Morris. We could be looking at supply chain risks. We could be looking
Yeah.
at transnational trade risks. So these are all of the pieces of the picture that would
Mm.
say that as we fill these out, we'll get more of an idea of what the
Mm.
complete picture. So certainly, we understand that we don't have all of the pieces, but
Mm.
we kind of know where the pieces are and the ones that we've got to get onto the board so that we can get a more holistic understanding.
Mm. Yeah, it's a fascinating area. I suppose the other impact is on employees of whether they can actually make it to work, to the factory or the office, given extreme weather. I mean, one of the mitigations that people put out is obviously insurance, but I guess it's going to prove to be quite expensive. Insurance is supposed to be, insuring something which is unexpected. To the extent we see more extreme weather, uh, we know the associated types of events, and therefore it's not so unexpected. Do you think
Mm.
insurance costs are going to go up around the world? And do banks need to worry about that?
Yeah. Look, I mean, we've certainly been predicting this for a while now. I mean, I think we've probably certainly we put out our first risk report on insurance risks in 2009, and so we have been worried for a while that there was going to be let's say a disruption or a correction that was going to have to happen in the
Mm,
insurance sector. I think we're seeing that now. I think we're seeing these sort of sudden jumps either in the cost of insurance or, as we're seeing, for example, in the US where insurance is being withdrawn. Um,
yeah.
the UK, effectively, you're seeing a withdrawal of insurance, but being replaced by a government scheme, flood
Mm,
re. If we look at, say, Australia, we're seeing insurance become either unavailable or unaffordable in
mm,
certain for certain properties, so quite targeted. So we're definitely seeing that the insurance industry is possibly a little bit late waking up to the fact that they need to fold climate change into their thinking. And what that means is that standard risk transfer tools, which says, oh, I don't need to worry about that because I pay my insurance premium, so my factory will be rebuilt or my home will be rebuilt, I think
yeah.
are now can't be taken for granted. And that means that if you're, for example, a bank lending money to a homeowner, or you're lending money to a company for its premises, um,
Mm,
you you as the bank need to take a long-term view, which is to say, not only is insurance available now, but do I honestly think it's going to be available at the end of the mortgage? So in a
yeah.
way, you're having to take a view, which is how much can I depend on the availability of insurance? So
Mm,
a lot of what we're doing is essentially calculating those forward premiums, and then the bank is saying, well, at some point, I need to acknowledge that that this borrower is going to have additional costs, which I need to factor
mm,
into their
mm,
serviceability.
mm,
That they may be more disrupted if they're a company, and that insurance, in fact, could be unavailable. In which case, I
mm.
could have a mortgage on a property, which, if anything happens, there's no ability to fix it up, which is obviously a very high default risk for a bank. Not a great
Yeah.
position.
Yeah. And presumably the value of the property will be much, much lower. So the security afforded by the property is not going to necessarily be sufficient for the bank. I mean,
Well,
do you think that governments across the world will have to step in and partner with the insurance industry to, if you like, underwrite some of these unknown risks or currently unknowable risks in terms of how
look,
extreme they'll be?
yeah, no, it's a good point. I mean, certainly if we're seeing that, the concept that the government is the insurer of last resort, I think,
Mm,
but that can't just be a blank check. There has to be a limit to that. So
yeah.
what we saw in the US, where there is a government insurance scheme, is we saw properties being damaged, rebuilt, and then within 2 or 3 years, another event comes along and they're damaged and rebuilt. Now, when you've done that 3 times, at some point, someone has to say, hang on, this is not working. We either need
Yeah.
to adapt that so that it's not going to get damaged the next time, or we need to say, sorry, move somewhere else. We need to buy that property back and just extinguish the title on it. Um,
Mm,
but certainly we can't see a situation where we keep rebuilding properties the same way as they were in the same zone. So I think the government intervention is really wasted money if it's
yeah.
on
Yeah.
rebuilding. Where it's well placed is if it's on adapting those properties ready for something. So imagine you've got the property, I'm going to rebuild it in a flood zone the way it was.
Yeah.
Instead, I could say that's in a flood zone. What about we build a flood wall around that? What about we build
Mm,
the perimeter of the building so that the doors and the windows are flood proof? What about if we raise the building up and we turn the bottom into a car park? All of those
Mm.
essentially is money well spent because you avoid
Yeah.
the losses down the track, and you essentially have a reasonably permanent solution. So that's where adaptation is going to be. I think that it's a bit like the light bulb has to go on, and we have to go realize that that's where the smart money needs to go.
Yeah. Yeah. XDR is rolling out standardized physical risk analysis to nearly 200 banks in Asia. Where did the idea for such a big project come from?
Um, Look, to some extent, it was a response to what we saw with some of the stress tests for physical risk that we saw with the Bank of England. We saw similar tests in Singapore, Australia, New Zealand, etc. But what we saw was some significant challenges with those. One was comparability. People were bringing back their results, but they were all using different models. The other thing we saw was access. Big organizations had big budgets, they could do a good job. Smaller organizations were somewhat being left out. And then the other thing was, sort of, if you like, one might call it transparency or auditability, which is to what extent can you see these results? So we'd been the Hong Kong Monetary Authority, had really been looking at these issues around the world, and the approach that they took responding to these issues was to say, well, instead of that, why don't we have a scheme that covers the whole territory? Why don't we have one scheme? Doesn't mean you can't do your own thing as well, but you have a system which you can use, which is the same for everybody, which is standardized. It's highly accessible. Banks, small and large, can access it, and it has very structured methodologies, high transparency. So in a way, it's quite exciting because I think they've looked at all of the challenges facing regulators around the world and institutions and tried to say, let's come up with the next solution. So we've been doing a project with the HKMA, and that's very exciting. It's rolled out this June 2024, and there'll be gradually a series of banks brought on until I think it's more than 180 banks in total will be using the system. So very exciting.
Yeah, a great project. So I think our time is probably up. For our viewers, we very much hope that you'll be able to join us at the Climate Adaptation and Resilience Summit in central London on the 1st of July. Further information is available at our website. Just remains for me to say thank you so much for sharing those thoughts today, Karl. Look forward to seeing you very much on the 1st of July.
Look forward to that event. I think it's a great lineup in the panel, and I think we'll have a very lively conversation.
Fantastic.